Hi there, you're listening to a conversation between myself, Leonie Jackson, journalist and writer from World into Words.
And me, Catherine Morgan, an investment broker from Talking Money.
Catherine and I share a passion for insightful conversation, and we hope that by sharing some of the topics we've covered, we can offer some helpful information or food for thought. So, Catherine, today we're talking about ISAs.
That's individual savings accounts.
Thank you. And in particular, different types of ISA and how they're likely to perform in the current financial climate. So, to start off, I wonder if you could give us an overview of what is an ISA and why they exist.
Sure. So ISAs have been around for several years now. Before that, they were called PEPs. It's the government's way of trying to incentivise people in Britain, if you're a taxpayer, for saving your money and investing it.
Yep.
Simply put, it is a wrapper and you choose what you then invest those monies into. But the protection of the wrapper means that you never then pay income tax or capital gains tax on anything that you buy or sell
Of
within
course,
those.
yeah.
I'd say that there are three main types of investment ISA. Now, some people will think, well, what about a help to buy ISA and property related ISAs? We're not talking about that today.
No.
We're talking just about when you save money, you can put your money into a cash ISA, a stocks and shares ISA, or an innovative finance ISA. And that last category we'll talk about in more detail, but it is a newer form of ISA. The ones that most people are familiar with, of course, are cash, which is like having a bank account with that tax-free wrap around it.
Yes.
Or the stocks and shares ISA, which is a bit more involved. You need to open an account with a broker and then hold stocks and shares. Again, you get the tax-free wrapper around how those shares perform.
Okay, so I guess my next question for you would be, with interest being so low at the moment, would these ISAs offer the kind of return that we would hope for?
I think it's really difficult to get a good rate of return anywhere, as you've said. The Bank of England rate is less than 1%.
Yeah.
And so most of us are not getting good rates of return with the banks. Now, when you go to a bank and you open a cash ISA, it's effectively still a bank account. It just has this tax-free wrapper.
Yes.
And annoyingly, the banks really see fit to give us as poor rates on the ISA as they do on a current account. So this weekend in the Sunday Best Buy tables, I think the best ISA rate was, I think it was 1 point something, so not at 2% yet.
No.
And if you then think about things like inflation, which is basically how quickly the cost of goods are rising, that is running at over 2%. So in simple terms, if you have your money stuck in a cash ISA, your money's not really even keeping up with itself. It's not going to enable you in a year to buy the things that you can today.
No,
because
it's
of the
impossible
interest
to
rate.
make money that way. Yeah,
Exactly. And that's why you hear so much in the press about the fact that it's very, very difficult to get a decent return. I'm not going to hide the fact I think cash ISAs right now are probably not the best way to boost your return. It's great to have a discipline though of saving, and I think some of this conversation is just about encouraging people to save. We know
yes,
women
absolutely.
are great savers. They're not so good at investing, and it's no surprise in terms of correlation. Most of the cash ISAs are held by women.
Right.
Most of the stocks and shares ISAs are held by men. So on a stocks and shares ISA, really you're more at the mercy of the stock market there. Now, some people might worry about that and think, well, gosh, I could lose it all. You can, because shares can dip right down, but they can also shoot right up.
Yes.
So that's why you are much more likely to see a sort of up and down bumpy effect on your stocks and shares. But in the good times, you can be getting a lot more than you can on a cash ISA.
Absolutely. And I know women and saving is something we're going to talk about in another conversation.
That's a whole conversation.
It absolutely is. Yes, absolutely. So I know also you're keen to raise awareness of an alternative type of ISA. Could you talk about that?
Sure. So that was the innovative finance ISA. I mentioned that at the very beginning. So these were issued or sort of permitted by the FCA back in 2017.
So quite recently.
Very recently, and really it was with the advent of the peer-to-peer lending market. So you will have heard of crowdfunders. and probably know people who've put a few pounds into a loan online.
Indeed, yes.
It's a sort of auction that the crowd, i.e. you and I, can participate in. Well, as those industries started to increase and the government saw that people were putting a lot of money into these loans, they're effectively replacing the bank. For the company who's getting the money, they're getting the money from the crowd instead of a bank. And so the government, in its wisdom, decided to let people hold their peer-to-peer loans within, again, an ISA wrapper. Good of them to do it. So they basically extended the 20,000 per person per year to say you could put it in cash, you could put it in stocks and shares, or you can put it in loans. You can hold loans. By function, it works the same though. You open an account, you can put up to 20,000 a year. Any interest that you're getting on the loans that you hold with those crowdfunding sites is then tax-free. That's it, simply.
Okay, well, thank you for explaining that. I think particularly with your keenness to raise awareness of this third type of ISA, would it be possible to perhaps look through some figures, some numbers, just to have a look at how those three different ISAs might perform?
Sure. So going back to that Best Buy table at the weekend, let's just say that you get 1% to keep it simple. So you put £10,000 into a cash ISA, and you get 1% on your money. So you get £100 after a year, which is really, pretty poor. Let's say you put £10,000 into a stocks and shares account. Now, individually, some of those shares or funds you're holding are going to be going up and down. But let's just say overall, you make 5%. That would be, I think, quite challenging at the moment. But typically, if we look back, equities tend to get something around 5 to 7%. So you would make, let's say you'd make £500 on your £10,000. So, that's looking a bit more rosy. A lot of the innovative finance ISA options that are out there at the moment are offering more like 7 to 8%. So on £10,000 after a year, you'd be looking at £700-800.
Right, now, it's quite a difference.
It's massive. Don't think for a minute I'm biased here. I mean, your stocks and shares ISA, actually, because it's volatile, it could end up making you 25%, in which case £2,500. But the point with that is it's volatile and we don't know. We can't say with any certainty.
No.
Cash ISAs we can say with certainty, and I've said already, right now you can be certain that that is very low. Innovative finance ISAs, I would say, with relative certainty, because those companies are going to tell you what interest they're paying you, and unless something goes wrong, that is the rate that you're going to get. So it is a promise to pay of sorts.
Okay, so picking up on these innovative finance, or I'm going to call them IF ISAs, I think I'm probably going to ask the question that would be on everybody's lips. What are the risks, and how well vetted are the companies that you're likely to be investing in?
I mean, it's a fair point, because at 8% or around 8%, you sort of wonder if it's too good to be true.
Absolutely.
And they've only been out a couple of years. So at the end of the day, I think all the providers can demonstrate is that they've been paying returns for, the times that they've been in operation.
Yes.
A lot of them are picking for you, so you don't have to pick the loans yourself. They bundle them up and they will offer you a packaged set of loans. But other times, if you want to, you can choose the loans yourself. The point is that they are the underlying investment. So if I compared it to stocks and shares, where your underlying investment is a share in a company that's going up and down.
Yes.
Here, you've got a loan being given to a company, and they pay a fixed amount of interest in return. Right. It's a more steady state. I'm not going to say it's safer, and even if they say we promise to pay you 8%, something could happen, and
there's always risks. Yes,
exactly. But they are committing to that, no more, no less. They're not saying that you need to be at the mercy of world events in the way that we are with shares.
Right.
If Trump builds a wall in Mexico, or if the Queen dies, or some of these things that are just totally outside of your and my control.
Or anyone's control, yeah.
Exactly, and that's the reality of how the stock market works, for good and for bad. With these kind of loans, I think it's about you, the investor, asking the questions of the ISA manager. So IF ISAs are offered by several. If you go online now and you just Google IF ISA, you can find many people offering them. And the question is what loans do they have inside them? How established are those companies? What default rate have they seen? They'll only give you 8% if those companies are actually servicing their loans and paying the interest. So it's not without risk, but it's a slightly different sort of construct as an investment. And usually the reason those rates are so high is because the borrowing companies can service that level of interest.
Yes, okay. So that's good to know. And I think another question that comes to mind is, are there any other costs that we should be aware of when making a decision to invest in an ISA?
Absolutely. I mean, at the end of the day, these are financial products, and there's a whole industry of people, brokers, organisations out there who want to take your money to help you invest. So on a cash ISA, I'd say probably they are the cheapest, if completely free, because you typically go to the provider, a bit like you would just go and open a bank account, only this has the ISA wrapper. So it's usually you to the organisation without cost. But once you get into stocks and shares or IF ISAs, you've got to go and find the ISA manager who will allow you to either pick the stocks and shares or pick the loans or do it for you, and they charge a fee. I can't say today, what's a ballpark, because my goodness, there is such a huge range. It often depends on whether you want them to manage it and select things for you, or whether you're happy to do your own, in which case you might just have a sort of marginal cost for transacting.
So if you're willing to do a little bit more of the work yourself, you may pay a lower fee. Is that what you're saying? Okay.
Yes. But a lot of ISA managers will levy a charge, and you obviously need to understand that charge before you work out what your net return is. The good thing to keep emphasising though is that all of these types of ISA, by the nature of what they are, they come to you tax-free. You get the interest or the dividend or the gain if it's a share value. You get that all tax-free. You don't have to go back to the government and put it on a tax return and pay across 20%, 40% to the government. So by and large, these are really great tax-efficient ways of investing. But yes, as you say, keep an eye out for fees.
Thank you. Well, sound advice. We appreciate you talking that through for us. So in summary, what is the key message you'd like to leave us with for perhaps making the most of the money that we earn?
I think the first thing is that you have to save if you can. I mean, we'll again talk in other conversations about saving versus investing.
Yes.
But the first thing is, if you can afford to put money aside, save if you can. This is an allowance you lose if you don't use it each year. You get to put 20,000 away per adult taxpayer per year. So
it makes sense to do so where at all possible. Yeah,
exactly. You use it or you lose it. And again, you've probably heard that there are people in the press referred to as ISA millionaires. That's because they've been doing ISAs and PEPs and so on from day one, from the minute that the government let you save these sums.
Right.
And the value has gone up each year. It's now at 20,000, and we think that will only creep up each year. So imagine you've been putting away the maximum you could every year, and then you've not just been saving it, but you've chosen to invest it in some good stuff. Your pot of tax-free savings now could well have exceeded £1 million. And that's amazing when you think about it, and you think how much tax we pay on things in the country. It's incredible to think that you can build up that level of wealth and then have that tax-free.
Yeah, absolutely. Lifetime. Well, it's been great to talk this through with you. I know we learned a lot from the topics that we discussed together, and as we've referred to, we'll be hopefully taking some more conversations to put out there, and
Indeed.
Hopefully they'll offer some useful advice for people and information for those that are interested in learning more.
Definitely.
I know future topics for those who may be interested are something close to our heart, how women save and manage money, looking at achieving financial security for our children, and a very hot topic at the moment, the future of property investment. So those are conversations I look forward to.
Great.
Thank you very much.
Thanks, Leonie.